Welcome back, everyone, to another Deep Dive Explainer. So today we've got a really fascinating challenge ahead of us. We're taking this incredibly dense, highly technical, 70-page strategy document for a specialized financial vehicle, and we're going to translate the whole thing into a clear visual roadmap. We're decoding the Arthaya Equity Long-Short Fund. If you've been looking for a way to actually understand the mechanics behind these higher-tier investment strategies without wading through literally endless legal jargon, well, you're in exactly the right place. Let's get right to it.
Okay, let's quickly outline our framework for today. We'll proceed in 5 straightforward steps. 1. Meet Arthaya SIF. 2. The long-short strategy. 3. Asset allocation rules. 4. Risk and benchmarks. And 5. The fine print.
Let's kick things off with Section 1, Meet Arthaya SIF. We first need to establish exactly who is behind this sophisticated investment product and what kind of container it actually lives in.
So this strategy is built under the banner of Arthaya SIF, which is powered by Union Mutual Fund. Now, it's really important to ground ourselves right here because this is an open-ended investment strategy. What does that mean for you? Well, unlike a closed-ended fund where your money is just locked away for years without daily liquidity, this vehicle actually allows for ongoing subscriptions and redemptions at daily net asset value or NAV prices. So it's definitely a specialized product, but it's built on that very accessible, familiar chassis of a mutual fund structure.
But what exactly is an equity long-short strategy anyway? Let's break down this complex jargon into plain English. You know traditional mutual funds, right? They're mostly long-only, meaning they just buy stocks and hope the price goes up. That's pretty much it. Well, this strategy is very different. While it definitely invests in equities for traditional capital appreciation, it also holds the power to use derivative instruments to take what's called a short exposure. Essentially, this means they can place calculated bets that certain stocks, or even the market itself, will actually go down. It's like a two-way street, designed to manage market risk and ideally enhance returns, regardless of whether the broader market is booming or taking a bit of a correction. Moving right along to Section 2, the long-short strategy. Let's dive in and see how this builds into the actual derivative strategy, because, as always, the devil is totally in the details here.
Now, what's really interesting here is the strict, hard boundaries the fund managers have placed on their bullish versus bearish bets. This absolutely isn't the Wild West. For long exposure, just buying stocks to hold, they can go all the way up to 100% of the net assets. But look at the other side. The unhedged short exposure is capped strictly at 25%. Think about what that tells us about the fund's core philosophy. They are using shorting as a highly precise, limited tool, not as the main engine of the entire fund. It's essentially a structural guardrail protecting against unlimited downside risk.
To be completely objective here, let's actually read the exact mandate straight from the source document. It says, to generate long-term capital appreciation over the investment cycle, employing limited short exposure through derivatives. So this confirms exactly what we just discussed. The primary objective is and remains capital appreciation over the long haul. The shorting is explicitly defined right there as limited, confirming its role as a supplementary tactic rather than the core identity of the portfolio.
Next up, Section 3, Asset Allocation Rules. This dictates exactly where the fund manager is legally allowed to park your money, acting as the true engine of the entire strategy.
Looking at the allocation breakdown, a really important fact stands out. Despite the fancy title and those complex derivative strategies we literally just talked about, this is fundamentally an equity-heavy fund. Between 80 and 100% of the total assets are mandated to be in equity and equity-related instruments. Debt and money market instruments capped at 20%. Same goes for infrastructure investment trusts, or INVITs. Make no mistake about it, your returns here are going to be overwhelmingly driven by the stock market.
But okay, here is where it gets incredibly fascinating. How in the world do you have an equity-heavy fund while simultaneously holding massive amounts of cash? Well, the strategy dictates that the fund intends to deploy not more than 64% of its assets in cash or cash equivalents, specifically things with less than a 91-day maturity. Why do that? Because they aren't just sitting on this cash, they're actually using it as collateral to fund those complex derivative positions, the stock and index futures we mentioned a minute ago. Any remaining cash is neatly deployed into tri-party repos, which are basically ultra-short-term, highly liquid loans. This ensures the fund always has the exact liquidity it needs to maneuver on a dime.
All right, Section 4, Risk and Benchmarks. So with all these moving parts, how do we actually measure the danger, and how do we measure the success?
Whenever you're dealing with unhedged short exposures and heavy derivative use, you have to acknowledge the risk profile. Take a look at the official AMPRI risk-o-meter pulled directly from the source document. Notice exactly where that dial is pointed. It sits firmly at level 5. That is officially categorized as higher risk. The document makes it abundantly clear that this specialized investment fund involves relatively higher risk, which completely includes the potential loss of capital and, of course, market volatility.
And so, what's the yardstick this fund actually has to beat to justify that higher risk and the complex long-short strategy? Well, the stated benchmark is the Nifty 200 Total Return Index, or TRI. This means the managers aren't just trying to beat your standard 50-stock index. They are playing on a much wider field. Plus, they're measuring their success by including all dividends reinvested, which is exactly what the total return part of the name means.
But you might be wondering, why the Nifty 200? Let's quickly connect the dots for you. Remember how we said this fund relies heavily on derivatives like stock and index futures? Well, you can't just short any random, tiny stock out there. You need serious liquidity to do that. This benchmark perfectly mirrors the top 200 stock universe, where derivative liquidity actually exists in the futures and options, or F&O space. It focuses predominantly on large-cap and mid-cap stocks where they can effectively execute those long-short trades while occasionally taking very measured exposures to small-cap stocks when they're hunting for that extra alpha or outperformance.
And finally, Section 5, the fine print. We really need to look at the logistics here, because this specialized investment fund is decidedly not designed for the casual retail investor just looking to park a few hundred rupees.
The barrier to entry here is pretty steep. There is a 10 lakh rupee minimum aggregate investment required across all investment strategies offered by Arthaya SIF at the PAN card level. Now, this high minimum is exactly what qualifies this as a vehicle tailored specifically for high net worth portfolios. The managers are targeting a very specific tier of sophisticated capital. However, once that initial 10 lakh rupee hurdle is cleared, the subsequent management to the portfolio gets a whole lot more flexible. Whether you want to set up a systematic investment plan to add funds, a systematic withdrawal plan to take cash out, or a systematic transfer plan, the operations run in structured 10,000 rupee increments. You just have to commit to a minimum of 6 installments. So it gives you a lot of structural flexibility right after that massive initial commitment.
And honestly, this brilliantly illustrates the fund's entire philosophy on investor commitment. Now, we noted earlier that this is an open-ended fund with daily NAV pricing, meaning technically you can leave whenever you want. But take a close look at the load structure. If you redeem your units within the first year, you get hit with a 1% exit load. But if you stay longer than a year, that fee drops to completely zero. The fund uses this structural penalty to strongly encourage long-term commitment. They want capital that's actually going to stick around long enough for their long-short cycle to fully play out. Which brings us to our final defining question. You understand the mechanics now. You see the 10 lakh entry cost, the unhedged derivative limits, and that level 5 risk profile. So the real question is, does your portfolio actually require a level 5 long-short strategy? It is a highly specialized tool designed to hedge risks and hunt for returns in volatile markets, but it demands serious capital and a pretty strong stomach. Take this visual roadmap, weigh it against your own sophisticated investment needs, and decide for yourself. Thanks so much for joining me for this explainer, and keep learning.